you can choose a date of completion. It's just a date where you are given the key to the property. And welcome, landlord. Welcome, landlady. You are now the owner of this apartment. Congratulations, landlady, landlord. Hi guys, you are welcome to this channel. My name is Dan and I talk about finance, education, entrepreneurship, business, money, investment, anything and everything that you need to be a success in life. You are welcome back to my channel. How do you buy your first property at 19? Whether you are 19 or you are 91, this video would help you to buy your first property in the UK, in the US, or anywhere that you stay in the world. In the course of this video, I will take you through 7 steps of getting your first property. A. This video will turn you from being someone that rents building to being a landlord or a landlady. You might have been wondering, I've been paying rent. It's time to get your own house. This video will take you step-by-step walk of getting your own house. The first step is savings. Yes, if you are thinking of getting your own apartment, you and I know that houses are not cheap. They come at a price. For you to acquire a house, you will need to put down a deposit. And this deposit, you can only get it most times by your own savings, or if you have your family members that want to offer you such amount of money. The ideal thing to do in considering of buying a house is saving up for it. I am not saying you should save up the total amount of the house you want to buy. No. You just need to save about 5 to 15% of the total amount of the apartment you want to buy. For example, you want to buy an apartment that costs roughly $400,000. It is wise for you to save anywhere from $20,000 to $60,000, which is about 5 to 15% of the total amount of the house you want to buy. If you put 5% down as your deposit, it is possible for you to get the house, but the interest rate will increase. Ideally, most banks or the high street banks would actually require you to have a 10% deposit of the total cost of the house. So you want to get a house of $1 million, all you need to deposit is $100,000. What if you want to get a house of $400,000? All you need to deposit in most cases would be $40,000. So your deposit for most accommodation is 10% of the total amount of the house. Sometimes it can be higher or it can be lower. It can be from 3% to 20%. Just as a guide, we go with 10%, which is ideal for most cases. If your deposit is low, the interest you will pay on your mortgage, which I will explain in a minute, will be very high. But if your deposit is high, the interest you will pay on the mortgage will reduce. So let's target 10% as deposit. And you need to save up for this deposit of about 10%. There are also other costs that I will explain to you that is involved in getting your own house. There should be about 5% of the total cost of the building. These costs are like the lender fee, survey, the solicitor's mortgage broker or mortgage advisor fee. So all these fees, you will be paid by you that want to buy the house. So, and they are roughly about 5% of the total cost of the building. So you see, that's why I advise you to save from 5% to 15% of the total cost of the building. Because if you're able to save 5 to 15%, you put a 10% deposit, and the remaining 5% will be used to handle all these other costs, other expenses that's related to buying a house. If you are lucky and you have family members or your parents want to support you with the savings. Excellent. In fact, that's even a very good option. That if your family members or your friend is ready to match up what you've saved, it even make your deposit to increase, thereby make your interest rate decrease. If your parents are supporting you with an amount of money, or your friend or your boyfriend or girlfriend or anybody is supporting you with an amount of money for your deposit, the person must write a statement declaring that that amount of money he or she is giving you is a gift, which means you are not repaying the person back, which means there's no repayment of the amount of money. This is important because the bank would like any money given to you to be as gift, not as a loan. That means you may have like a double loan to pay, which the bank would not be impressed with. So if you are expecting money from a family member or from your parents, they need to write a statement that such amount of money is a gift, which means there's no repayment of it. At this point, I would also like to tell you that depending on the government of your country, there are some initiatives to help first-time buyers, such as Lifetime ISA, Help to Buy ISA. ISA simply means Individual Savings Account. You need to check out on your government and see if there's any initiative or program that will help first-time buyers. And if they are, please try to maximize it, because they are there to help you buy your first accommodation at a lower cost or at a lower interest fee. So please check out the government of your country out and see if they are available. Please maximize it. Hello guys, please like this video, smash the like button, destroy it off the like button so that YouTube will recommend this video for other people to view it and buy their first property just like you. The second step you need in getting your own house is you need to know the amount of money you can borrow. What is mortgage? Mortgage is simply the amount of money you borrow to buy a house. A mortgage is simply a loan you take to buy a property. Following our discussion, you want to buy a $400,000 house and you already have a deposit of $40,000, which is about 10%. So the remaining $360,000 that you need to buy the property, how do you get it? You need to know how much you can borrow. You need $360,000 does not mean a bank give you $360,000. They may give you less, they may give you more. So it depends on your circumstance. What are the things that affect how much you can borrow? Typically, a bank will be ready to give you about 4 to 5 times your basic salary. So if your salary, for example, is $50,000, a bank will be ready to give you about 4 times that your basic salary. So 4 times $50,000 is $200,000. So which means a bank would likely give you about $200,000. But you need 360, and the bank is just telling you they can only give you what? $200,000. Now, which means that if your income increase, let's say you do a multiple job, or you and your partner, your boyfriend or your girlfriend has a job, and two of you want to buy a house together, and for easy calculation, they earn the same thing like you, which is 50 times 2, which is $100,000. A bank will be ready to give you 4 times that amount, and 4 times 100,000 is $400,000. So you see, you even get more mortgage than you need. In order to get a higher mortgage, think of your basic salary. It could be from 1 job, from 2 jobs, or from 3 jobs. If you don't have multiple jobs, you should think of your partner, if 2 of you can combine to buy a property, because the basic salary you present to the bank will impact the amount of mortgage you can get, and it's basically about 4 or 5 times your basic salary. And if you are 2, the bank will add the 2 basic salary together and multiply it by a multiple of 4. And if you are doing a second job, most likely the bank will multiply the second job earning by 60% and add it to the basic salary and multiply the whole sum by a multiple of 4. So which means that if you want to get a higher mortgage, your basic earning, or you and your partner basic earning, should be higher. In the example that I'm taking you through, which will need a mortgage of about $360,000. It means that I will need like a basic salary of $90,000. There are some banks that may give you more, and there are some banks that may give you less. How do you know more about this? You can speak to a mortgage broker. A mortgage broker is someone that has a list of lenders, banks, or building society, and knows their interest rate and the amount of money they can give you. It's like your advisor on getting a loan, which is called mortgage in this case. Some of them may charge you for it, and for some of them it will be free. For those of them that it is free, they may not be as serious as those of them that may charge you for it. But if they charge you for it, it's likely about $500 to $1,000. Also, we're in a modern world, so there's no need of really giving yourself headache to look for a mortgage broker. Most banks have a mortgage calculator. You can go to a bank and just type the name of the bank you like and type mortgage calculator. Then you will see the amount of money you can get. Also, there are some websites like Compare the Market, Habito, that has mortgage calculator, the amount of money you can borrow based on your basic salary. Just go online, type mortgage calculator and see how much you can borrow, and different lenders that are ready to give you the amount of money that you want. So once you know the amount of money that you can borrow, you can request for a statement from that website that you are using or your mortgage broker if you choose to go with a mortgage broker. All these online websites are like online mortgage brokers. So they can also give you a statement of the amount of money that is possible for you to borrow from a bank. And that statement they will give you is called mortgage in principle. Mortgage in principle is simply the amount of money that you can borrow from a lender. It shows you the total possible amount of money that you can borrow. So once you've gotten that statement, which is the mortgage in principle and agreement in principle, with your savings, you now know the total amount of money that you have or that you can have to buy your house. The next step is searching for a property. This is the fun part, where you go to Rightmove or Zoopla to go and search for the best property you like, any kind of property that you want. Because you have a range of the amount of money that's possible, in our own case, $400,000, you can start searching for properties in a location that you like that is within that range of $400,000. Don't limit yourself to $400,000 only. Put a range of $360,000 to like $440,000 within that range. So search for the location you want, search for the property you want. Don't go with a property that looks beautiful only, because even though it looks beautiful in the eyes, most times the owner of the property will pack those things out when it's leaving. Therefore, it will not look as beautiful as what you are seeing. So you should be more interested in the area. Is the area safe for you? Is the area safe for you to live in? Can the property appreciate over time? And some other important metrics that I will tell you in more videos that I will create on real estate. Also, when you find a property that you like, message the real estate agent that's handling that property, and you make an offer to the real estate agent in charge of that property. Let's assume the cost of the property that you saw and you like is about $420,000. But from your mortgage in principle and your deposit, you know you can only pay about $400,000. Hey, don't be afraid to negotiate. Most people that buy their buildings negotiate, and it's not a crime for you to negotiate. You can always get $10,000 or $20,000 out of that amount you are seeing on the website you are checking. Feel free to negotiate. There's no crime in negotiating in buying your first property. Of course, don't start with a ridiculous amount. Don't go with the stated amount. Try a little bit of negotiation, and most times they will drop the price down by roughly $10,000 for you. When the agent has agreed now for you to get the property, you can make an offer. In your offer, you should write terms and conditions. Know that making an offer does not make it binding on you to pay the amount of money. So put your own terms and conditions in the offer document. Welcome to the fourth stage. The fourth stage is where you do your mortgage application. Mortgage application is where you now officially make an application for a loan to a bank or lender that you like. On the side of the bank, they will ask you for your document in order to confirm that you are who you say you are, your address and some other details like that. They will run a credit check on you. The purpose of credit check is, can you pay back the loan they give you? They want to prove that you can pay back the loan based on your history of spending money in the past. Have you ever bought something before and did you pay back on time? So that's what they will check through your credit score rating. At this level, I will encourage you to start working towards building your credit score. A credit score of 740 will be ideal to get a loan from High Street Bank. If you want to find out about your credit score, it is good for you to even use what your bank will use. Your bank will check your credit score from 3 companies, and all the 3 companies can give you the credit score now. If you go to annualcreditreport.com and request for the 3 credit reports they can offer you. Don't request for one, request for the 3 of them now for you to know your credit standing. Know that the bank will take the average of it. If you have 720, 740 and 760, they will take the average, which is 740. You can get your credit report free of charge. So that's what the bank will use as one of the metrics in order to offer you a loan. Also, they will also carry out an affordability assessment. Are you paying other loans like student loans, car loan, insurance loan, or whatever loans that you are also paying? So they will check other loans you are paying to see if you can be able to pay back this mortgage back and still live a comfortable life. At this point of applying, don't have so many loans that you are paying back on you. If you have student loan, try and pay it off. Or other loans that you have, try and pay it off so that it will not tie you from getting the amount of money that you are expecting from the bank. And finally, the bank will do a valuation survey on the property. It's just a survey where they check the property to see if it really worth the amount of money that you want to pay for it. It's not bad on your own end. It's good because you can even use it to renegotiate the property if it's far below. The affordability assessment also includes your debt to income ratio. What debt do you pay from the total income that you get? So if your debt that you are paying is very high, it will limit or hinder you from getting a mortgage from the bank. But if your debt is very low or you don't have any debt, wow, excellent. Now the bank will offer you a good mortgage agreement with excellent interest rate of about 2 to 3%, if not lower than that. Step 5 is conveyancing. Yes, this is the point where you involve a solicitor. You want to buy a property, it will be good for you to have a solicitor to put things under legal terms so that you won't be surprised in the future that the property that you bought is no longer your property. Also, the solicitor can also help you in speaking with local authority to be sure that the property is in the right place and you don't have drainage or water problem, or the property will not damage the environment and will not be harmful for you in the future. So everything related to legality, the solicitor, the conveyancer would help you in those areas. The 6th point is survey. I told you earlier that the bank will do a survey. The survey the bank will do is a basic survey of the price of the property and other basic things. But you, the owner of the property, it's advisable for you to go in depth. It's your house. You really want to know what it actually worth so that you won't be surprised in the future when you see that the roof is leaking. So you involve a surveyor to have a deep dive survey of the building. You want to be sure that the structure of the building can stand the test of time, that the roof is not leaking. You also want to ensure that the electricity is working very well, or any other thing that you don't want to renovate is intact, so that you know the part you are renovating and the part that will remain intact for you. If there are areas that will involve you renovating at a high cost, you can speak to the estate agent in order to reduce the total cost of the apartment for you, since you are paying a lot of money in renovation. So once you've done your deep dive survey and the result came out fine, and the bank now has offered you a mortgage, woo! Now you are winning. What you do now is exchange. So exchange involve your solicitor exchanging the contract with the real estate agent solicitor. So now there will be an exchange of contract saying that officially you are now the owner of the building. Of course, before the exchange, you have to transfer the mortgage you've gotten with your deposit to your solicitor bank account. Then your solicitor will transfer the amount to your real estate agent solicitor. So once the money has been transferred, you can start doing exchange where you exchange the document of the building, and now you become officially a house owner. Then on the same day or on a different day, in less than a week or 2 weeks, you can choose a date of completion. It's just a date where you are given the key to the property. And welcome, landlord. Welcome, landlady. You are now the owner of this apartment. Congratulations, landlady, landlord. The house is now yours. You pay back your loan. You do the repayment according to the terms and agreement you've agreed with your lender. And thank you. That is the whole stage of buying a property. Finally, I'm not a financial advisor or a mortgage broker or a mortgage advisor. So please take this advice with caution and do your research discreetly and dutifully well before going to purchase your first apartment. Thank you guys for watching this video. Please like, share and subscribe. Hello guys, please like this video, smash the like button, destroy it off the like button so that YouTube will recommend this video for other people to view it and buy their first property just like you.